Okay, you guys, chapter 20 deals with accounting changes and error corrections. I thought we'd go through some notes on those before we look at an exercise that deals with each of the three situations at least once. First, a change in an accounting principle. The example the books usually use, and if you've read the chapter, you've already noticed they use it here, is a change in inventory methods. That's considered to be a change in an accounting principle. So if you go from FIFO to LIFO or LIFO to FIFO, that would be a change in accounting principle. And those are accounted for retrospectively if possible, which would mean that we go back and revise comparative financial statements. Let's say we're switching from FIFO to LIFO. Or let's say we're switching from let's go the other way. Let's say we're switching from LIFO to FIFO. Then we would go back and state the comparative financial statements, meaning if we were showing 2016 and 15, we'd go back and state the 15 financial statements as if LIFO had been used the whole time, 15 and 16. They say the advantage there is it makes 2 years comparable. And we'd also adjust the accounts, of course, and disclose the change in the notes to the financial statements. Now, these changes in accounting principles are accounted for prospectively, meaning retrospectively means we go back and change prior year's financial statements and adjust the accounts as if that principle had been applied from the beginning. Prospectively, we account for changes in accounting principle that way when the retrospective approach is impracticable. A lot of times for LIFO, you would have to have different cost layers. Well, if you had been using FIFO and you were changing to LIFO, it might be difficult to go back and restate those prior years because you wouldn't have those cost layers. So if it's impracticable or impossible to go back and restate the financial statements as if this principle had been used all along, then the change is accounted for in current and future years. That's prospectively. And prior year financial statements are not revised. So we do revise prior year financial statements when we have a change in accounting principle if possible. If not, we account for it in the current year and going forward. With a change in accounting estimate, it's always accounted for prospectively, meaning in current years and going forward. And prior year financial statements are not revised. Error correction, it needs to be accounted for retrospectively, meaning we go back as far as the error and correct it going forward. And we disclose that in the notes to the financial statements as well. Okay, you guys, we're going to look at a change in an accounting principle first. Thanks.